Bienvenidos a Finance for Rookies, the show that makes finance fun instead of just, well, finance. Today we're diving into something that might sound a little intimidating: bonds. I know you're probably thinking, bonds? Is that like something my grandma buys at the dollar store? But don't worry, we're going to make it simple and actually kind of fun. By the end of this, you'll be ready to talk about bonds like they're your new BFF. Vamos. So you're probably thinking, what are bonds? Are they like the fancy papers I get in the mail? Do I need a magnifying glass to read them? Not quite. But if you've ever dreamed of becoming a bond master, you're in the right place. Let's break it down step by step in a way that's even easier than finding your TV remote under the couch cushions. Yeah, we've all been there. So, what exactly are bonds? Are they like those fancy pieces of paper that show up in your mailbox and you wonder if you need a magnifying glass to read them? Not exactly. Bonds are debt securities issued by companies or governments to raise money. It's like you're lending money to a company or government, and they pay you back with interest over time. Sounds like a pretty sweet deal, right? All right, let's break it down. A bond has a few key terms you should know. 1. Par value. This is how much the bond is worth when it matures. Think of it like the face value. For example, a $1,000 bond means the issuer will pay you $1,000 when the bond matures. 2. Coupon rate. This is the interest rate you'll earn on the bond. Let's say the coupon rate is 6% on that $1,000 bond. You'll get $60 a year in interest. 3. Maturity date. This is the day the bond issuer has to pay you back the full $1,000. Think of it like a loan you gave someone that they'll pay back in full later. 4. Yield to maturity. YTM. This is a fancy term that basically tells you the total return you'd get if you held the bond until it matures. It's like the bond's overall performance report card. Now let's get a little nerdy and talk about bond valuation. But don't worry, it's not as hard as it sounds. Imagine you're pricing a bond like you're shopping for a new phone. You could go cheap or you could go for the fancy one with all the bells and whistles. But in the world of bonds, pricing comes down to 3 things. Step 1. Identify the amount. How much is this bond going to pay me? In our case, let's say it's $22.50 a year. Sounds nice, right? Step 2. Determine rate. What's the discount rate? Think of this like the interest rate you're using to figure out how cool this bond really is. Spoiler: if the rate is low, the bond looks pretty attractive. Step 3. Find value. This is where we do some real magic. We use the present value formula to figure out what all those future payments are worth today. Yep, the time value of money. Fancy stuff. But don't worry, we won't make you do it alone. Step 4. Add it up. At the end of the day, you just add up all the values from step 3, and boom, you've got the bond's current price. See? No sweat. But here's where things get fun. Premium bonds, discount bonds, and par bonds. If the bond's coupon rate is higher than the YTM, it's called a premium bond. It's worth more than its face value. If the coupon rate is lower than the YTM, it's a discount bond. It's worth less than face value. If they're the same, it's a par bond, which sells for exactly the face value. It's like buying something on sale. If you're getting more than the sticker price, you're getting a premium. If it's on sale for less, it's a discount. Easy, right? Okay, let's talk about risks, because there's no such thing as a risk-free investment. With bonds, there are a few things you need to keep an eye on. Interest rate. Risk. When interest rates go up, bond prices go down. So, if rates rise, your bond might lose value. Default risk. If the company or government you loaned money to can't pay you back, that's bad news. Liquidity risk. Bonds aren't always easy to sell quickly, so that's something to think about. Basically, bonds are like a first date. You gotta trust them. But don't be surprised if things go sideways. Just like you check Google reviews before buying a new TV, you can check bond ratings to see how risky they are. The top 3 reviewers in the bond world are Fitch Ratings, Moody's Investor Service, Standard& and Poor's, S&P. So check those ratings before you buy, or you might end up with a one-star bond. And now, for the trick to keep your bond investments chill, bond laddering. This is like putting your money in different bonds that mature at different times. So, when one bond matures, you roll it into a new one. It's a lot less risky than betting everything on that one long-term bond that could get hit by a surprise interest rate hike. Smart, right? So, to sum it all up, bonds are like loans you give to companies and governments, and they pay you interest in return. Just remember, bonds have risks, just like that time you trusted your friend to pick the movie. But with the right knowledge, you can nail the bond game. All right, rookie investors, you're now equipped to talk bonds like a pro. Go impress your friends or maybe just your grandma next time you're at dinner. Catch you next time when we talk about, I don't know, maybe we'll explain stocks next, or a recipe for homemade pizza. Who knows? Either way, you'll be entertained and you'll be learning. Adios.